Hi there, this is Uttam. In this video, I will explain you about mortgage loan amortization schedule, which is free in Microsoft Excel. Very useful tools to know own bank loan schedule. Let's start. Open Microsoft Excel worksheet. Right click on the sheet 1. Follow the step 1. Then select the insert tab. Click on spreadsheet solution, loan amortization, then OK. New Excel tab will automatically insert it by Excel. Here, loan amortization schedule, enter values. We see loan amount, annual interest rate, loan period in years, number of payment per year, start date on loan, optional extra payment, lender names. These are the input which we have to supply to the Microsoft Excel, and the rest of things it will calculate automatically. And in the next table, there is a loan summary. We will go each section in brief. Let's start. Loan amount, for example, I have planned to take loan amount of $100,000. Enter it here. Go to the next section, and here, what is the interest rate provided by the bank, or the bargaining figure with the bank? Interest rate per annum. For example, 5% per annum. And loan period in year, how many year loan we have demanded with the bank. For example, we have demanded for 20 years. And number of payment per year, how often are we going to pay to the bank? Monthly means 12 times in a year. And another section is start date of loan. Let's say 1st January 2020. Extra payment, this is optional. It says here, enter an amount here if you want to make additional principal payments every pay period. For occasional extra payment, enter the extra principal amount directly in the extra payment. We'll discuss about this below section in the below table. I recommended this section to leave blank. And here the lender name, or the bank or finance supplier name, for example ABC Bank. Once we enter these 5 figures, loan amount, annual interest rate, loan period in years, and number of payment per year, and the start date of loan, Excel calculates automatically the loan summary here and the details of loan summary for each period. Schedule payment. This is monthly principal plus interest amount, which we have to pay every month. Schedule number of payment 240. This is the product of this loan period in year multiplied by number of payments per year. Meaning to say, if we multiply these two figures, this is the month. Meaning to say, this is the month, and actual number of payment is the same. When we pay early the principal, this actual number of payments will dwindle. Total early payment, this figure appears when we encode into the extra payment. Once we pay the extra payment, which is deducted from the principal value at the time, it appears here. And total interest. Total interest value for actual number of payments. This is changeable when entering the extra payment. So this total interest, if we see the cumulative interest here on the bottom, it's the same. So this PMT, these are the month, first month, second month, third month, fourth month, fifth, and so on up to 240 months. This is the payment date. Start date of loan is 1st January, then after the 1 month, that means second month or the February, the payment date. We have to pay after 1 month because we have declared here monthly. And the beginning balance in the first month is the same loan amount, and the scheduled payment also appears the same, which is principal plus interest. And leave for a while the extra payment, we'll talk about it later on. And the total payment, this is the principal and the interest amount. In this case, for the first month it's the same, equivalent to scheduled payment. And the ending balance, this is deducted value. And the cumulative interest is for the additional or the all the total interest, accumulated interest. Let's jump to the second month of payment. We see the date here and the beginning balance. The ending balance of previous month is the beginning balance for the this current month, and the scheduled payment also same, and Excel calculates the same way. So total payment is a principal and interest. If we add this principal and the interest, it appears here. Let's go for the extra payment. For example, in this month, if we have some extra income or spare amount which we can pay to the bank, and if we enter here, let's say $1,000, then it changes all the values below here. This $1,000 will add to the principal because Excel first calculates the interest, or the bank takes first interest, after the remaining value will be principal. So principal is added by the 1000 and the total payment also increase, and this value is deducted from the principal amount. So interest and the ending balance, this ending balance will be beginning balance for the next month, and we can see the changes in the cumulative interest as well as on the top where the scheduled number of payments and the actual number of payments change. If we remove this value extra payment here, we can see the changes in the actual number of payment. Let's check it out. See, if we pay $500 here, total early payment will appear here and the total interest rate functions. This is how we can calculate our loan amortization schedule ourselves by clicking just few information either in our iPhone, Android mobile, laptop, or any spreadsheet, Microsoft Excel. Thank you very much. Thanks for watching.